Welcome back to Investing Talk Podcast. Today we're tackling a really interesting question from a listener. Is Eaton Corporation a good buy right now? This is one of those diversified specialty industrials, and it's sitting right near its all-time highs. Pretty impressive.
It really is. It's been on quite a run.
So we've gathered the latest analysis, fundamentals, technicals, what the big catalysts might be. And hey, before we jump in, if you find this helpful, please do subscribe, maybe give us a like, leave a comment. It really helps us out.
Yeah, absolutely.
And definitely, if there's another company you're curious about, just drop it in the comments. We do look at those.
We do.
Okay, so our mission today, understand why Eaton has this, premium valuation compared to its peers. Is it justified?
Wait, is the growth story real enough?
Exactly.
Yeah.
And what are the real risks and rewards here? Thinking about both short-term plays and maybe longer-term investing.
Okay, so kicking things off with the fundamentals. The big picture here is that Eaton is showing, well, really robust financial health and accelerating growth, which is key.
Accelerating, okay.
Yeah. If you look at their recent performance, say Q2 or Q3 of 2025, revenue hit about $7.03 billion.
Which is decent growth.
It's strong. That's up 10.7% year over year. And importantly, their earnings per share came in at $2.95.
Okay.
That actually beat the consensus estimates by about 3 cents. Not huge, but it shows they're executing.
Right. Beating expectations is always a good sign. But you mentioned acceleration. What's the outlook look like? What are analysts expecting going forward?
That's where it gets really interesting and probably explains some of that premium we talked about. The consensus is pretty compelling.
Yeah.
They're expecting revenue to grow from, let's see, an estimated $24.88 billion for this full fiscal year 2024
Okay.
to jump to around $27.77 billion in fiscal 25. That's an 11.64% year-over-year increase. Pretty solid top-line growth.
That's definitely healthy for an industrial.
But the real story, like we often see, is the earnings leverage. The projected EPS growth for 2025 is forecast to be a whopping 27.85%.
Wow, nearly 28%. Okay, that's significant.
Huge jump. And analysts don't see it as just a one-year blip either. They're forecasting continued double-digit growth, around 13% for 2026.
So sustained strong growth.
Exactly. And the company itself seems confident. Their own guidance for FY 2025 EPS is in a pretty tight range, between $11.97 and $12.17.
That does suggest they feel good about their visibility, doesn't it?
It really does. High confidence in the pipeline.
And looking beyond just the growth rates, the quality metrics, they seem pretty impressive too. I'm seeing a net margin around 15.11% recently.
Yeah, strong profitability. And, a great indicator of management quality is return on equity, the ROE.
Right.
Eaton's ROE is sitting at an impressive 23.91%.
23.9. Wow. In the industrial sector, that really stands out.
It absolutely does. It tells you they're using shareholder money very effectively to generate profits.
Okay. And the balance sheet looks solid too. Debt to equity isn't crazy, 0.47. And liquidity seems fine. Quick ratio, 0.76. Current ratio, 1.24. They seem financially sound.
Yeah. Overall health is good. Working capital looks fine. Debt is manageable. Solid foundation.
Okay, let's unpack this premium valuation then. Because this is really the core question, isn't it? Performance is great. Growth forecast is strong. But that valuation, it just looks high.
It does. This is the crux of it.
The market cap is around $146 billion. And the PE ratio, 37.72. That feels steep.
It is elevated, no doubt about it, especially when you put it side by side with competitors.
Exactly. I mean, look at ABB, another big player. Their PE is around 21, maybe 22.
Yeah.
Emerson Electric, closer to 24.
Right.
So Eaton's trading at, what, roughly a 50% premium to those guys?
Which naturally leads to the question, why? Why are investors paying so much more for each dollar of Eaton's current earnings?
Is it just hype? Or is there something structural going on?
I think it's structural. This isn't just random market sentiment. The valuation reflects really high expectations for future growth and, importantly, margin expansion. See, Eaton isn't really a generic industrial anymore. They've spent years optimizing their portfolio, selling off lower margin, more cyclical businesses.
The older industrial stuff.
Exactly. And reinvesting heavily into high growth, high margin areas. Think electrical components, power management, e-mobility.
Ah, so they've shifted their focus toward these big secular trends, electrification.
Precisely. They fundamentally changed their business mix. So the market isn't valuing them like a traditional industrial. It's giving them more of a growth stock multiple.
Because they're playing in faster growing, higher margin markets now.
Right. And management has backed this up. They have a strong track record now of increasing return on invested capital, ROIC. They're targeting mid to upper teens, which is ambitious, but they've been delivering.
Okay, so the premium is basically a payment for perceived quality, that track record, and exposure to these big growth themes like electrification and maybe even AI infrastructure.
I think that's a fair summary. Investors are essentially saying, we believe you'll deliver that 28% EPS growth next year, and we're willing to pay for that confidence today. It's forward-looking.
That makes sense. It explains the gap with peers who might be more exposed to, say, traditional manufacturing cycles.
Exactly.
All right, let's shift gears a bit to the technicals. For someone thinking about maybe timing an entry, where does the stock actually stand right now, price-wise?
Okay, so as of September 19th, 2025, the price was $374.95.
Which is, like you said, very close to that 52-week high. What was that high again?
Around $399.56. So yeah, it's right up there. Not exactly buying it on sale.
Definitely not. But what about the trend? Is it looking healthy, technically?
The trend is definitely strong. It's in a sustained uptrend, trading clearly above both its 50-day and 200-day simple moving averages.
Okay, what are those levels?
The 50-day is around $363.57, and the longer-term 200-day is back at $329.32. Holding well above that 200-day is usually a good sign of institutional support.
And is it looking overbought? RSI?
Actually, no, which is interesting given the price level. The RSI, the Relative Strength Index, is around 56.22.
So neutral-ish, maybe slightly bullish, but not stretched.
Exactly. It's not in that territory above 70 where you start worrying about a sharp pullback just because it's overbought. And volatility has been moderate, too, around 2.6% recently.
Okay, what about key support and resistance levels people might be watching?
Analysts seem to be looking at near-term support in the, call it 356 time to 365-hour range. That's kind of the zone it needs to hold to keep this immediate uptrend going.
And upside resistance, where might it run into trouble?
Resistance looks like it's clustered around $390 up to maybe $411, basically right around that all-time high and just above it.
And that lines up with where the analysts see it going.
Pretty much perfectly. The average price target from the, I think, 24 analysts covering it is $390.68.
Which implies not a lot of upside from here, like 4%.
Yeah, roughly 4% upside to the average target. The overall consensus rating is moderate buy.
But it's interesting, there seems to be a bit of a tug of war in sentiment recently. Saw some upgrades. Melius went to buy with a huge $495 target.
Yeah.
Daiwa to strong buy.
That's right. Some analysts are clearly very bullish, seeing much more room to run.
But then Wall Street Zen just downgraded it to hold a week or so ago, basically saying the run-up captured the near-term potential.
Exactly. And that tension really highlights the core debate. How much of the good news is already in the price? You have bulls looking at the long-term trends and more cautious voices looking at the current valuation multiple.
And the broader market isn't exactly screaming risk on either, right? The fear and greed index.
No, it's show and fear. The Coin Codex index was recently at 39, which is definitely in the fear zone. So Eaton is a high flyer in a market that's generally feeling a bit nervous.
Okay, this is where it gets really interesting then. Catalysts. What could actually move this stock, especially given that high valuation? Near-term stuff first.
The biggest one, no question, is the upcoming Q3 earnings release. That's scheduled for October 15th.
Right. Everyone will be watching that one.
Absolutely. Given that tight guidance they gave, analysts will be parsing every word. Any hint of slowing momentum or maybe another guidance raise, either could cause a significant reaction.
And beyond earnings, any other triggers soon?
Well, you've got institutional flow events, the big ETF rebalancing at the end of October. That can sometimes drive buying if a stock's weighting increases. And then the 13F filings in late November will show us what the big money managers did with Eaton in the last quarter.
Okay. And thinking longer term, what are the big structural drivers people are betting on?
It really comes back to those major themes we touched on. Electrification, energy efficiency, e-mobility. These are huge, multi-year, maybe multi-decade shifts.
And Eaton is right in the middle of it, selling the essential gear.
Precisely. They're providing the components, the systems that make all this possible. And one theme that's really getting highlighted now is AI infrastructure demand.
The data center build-out.
Exactly. Think about the sheer amount of power these new AI data centers need. Reliable, efficient power. Eaton's Electrical America segment makes the switches, the breakers, the distribution stuff.
The pick and shovel play for AI power needs.
And that's a great way to put it. And that segment has been posting record sales and margins, reportedly driven specifically by this demand. It's a massive tailwind right now.
Are there any more speculative things floating around? Rumors?
There's always chatter with stocks like this. Some talk about potential acquisitions, maybe in industrial automation or grid tech, to boost their digital offerings.
Which could make sense strategically.
It could. And the market might give them the benefit of the doubt, given their execution track record. There are also some unconfirmed whispers about potentially landing major new contracts for some of these big AI data center expansions.
Ooh, okay. If those turned out to be real.
Yeah, that would likely give the stock another leg up. But again, just rumors at this stage.
Right. So lots of potential positives. But we have to talk risks. Even with great growth, things can go wrong, especially when expectations are this high.
Absolutely critical to consider the downside. The number one risk, I'd say, is execution risk.
Meaning just not hitting those ambitious targets.
Exactly. If they fail to deliver that near 30% EPS growth, or if their margin expansion stalls, or they miss those ROIC goals, the market could punish that premium valuation very quickly. You could easily see a 15-20% pullback if they stumble.
Makes sense. What else? You mentioned potential M&A.
Yeah, integration risk.
Yeah.
If they do make acquisitions, there's always the risk of overpaying or struggling to integrate the new business smoothly. A bad deal could dilute value and distract management.
And finally, there's still an industrial company at heart, right?
They are. So you always have global industrial cyclical risk. If there's a major economic slowdown, companies pull back on capital spending, and that could hit Eaton's orders, even in the growth segments. They're less cyclical than they used to be, but not totally immune. And supply chain issues can always pop up again.
Okay, so putting it all together, for our listener who asked, is now the time to buy Eaton at $374.95? What's the final take?
Well, based on everything we've looked at, our overall rating comes out to an 8 out of 10.
An 8. That's pretty strong. What's the core reasoning?
The reasoning is solid. The financials are healthy, the growth path looks strong, and it's clearly driven by these powerful long-term trends like electrification and AI power demand. And their market leadership, plus that portfolio transformation they've done, really does seem to justify paying a premium compared to slower-moving, more traditional peers. The quality is there.
But you highlighted the importance of the investment time frame earlier. That seems crucial here.
Absolutely essential. We think Eaton is best suited for a long-term investment.
Meaning not for someone looking for a quick pop.
Probably not. If you're a short-term trader, the math just isn't super compelling right now. The average analyst target suggests only maybe 4% to 7% upside. You'd be betting on a big earnings beat or one of those rumors panning out to get significant near-term gains. The risk-reward for short-term trading looks less attractive up here.
Not more for the compounder.
Exactly. If you're a long-term investor, you're buying into that multi-year structural growth story. You're betting on the electrification and AI themes playing out over years, allowing those future earnings, the 2026, 2027 earnings, to eventually justify and grow into today's valuation. You hold it, let management execute, and let the themes play out.
That's a really clear way to frame it. Okay, so wrapping up, we know Eaton is riding these huge waves of electrification, AI, infrastructure demand. That explains the strong performance and why investors are paying up for it. But with that PE so much higher than its peers, here's the final thought for you to consider. How much of that amazing, undeniable future growth is already reflected in today's $374.95 share price? And critically, how much growth is still left on the table for new investors coming in today?